Hey, what's going on, everybody? My name is Spencer Gray, and I'm the president and CEO of Gray Capital. We're a multifamily investment firm based out of Indianapolis, Indiana, and we've got really exciting new investment opportunity available to accredited investors. It's a Midwest value add project based out of Evansville, Indiana, that we just couldn't be more excited about. We've got a webinar scheduled for Thursday, February 20th at 1 p.m. Eastern. I want you to mark that on your calendar. Go to our website, graycapitalllc.com, to find out more information. It's going to be on YouTube Live, so you can also go into our YouTube channel. Wanted to make sure that you're aware of that date because in addition to watching this video where I'm going to do an overview of everything that's going on with the project, the business plan, the returns, the risks, and the potential upside, we give you an opportunity to ask all of your questions in a live environment with other potential investors. But also, if you're interested in this project, it sounds interesting, make sure you schedule a meeting with our team. Information to do that is going to be linked below here. We can also go on to graycapitalllc.com to learn more about the project. I was going to wait for the webinar, but I'm so excited about this deal. I wanted to put this video together, so especially if you're a prospective investor, you can kind of hear it straight from the horse's mouth before we even jump into a meeting with us, so you can get as much information to prepare yourself. We also have a ton of due diligence materials located over at the Gray Capital portal. So again, if you go over to graycapitalllc.com, you'll see two links. One of those will allow you to create an account on our portal, or if you already have an account, you can log in, go to the River Club opportunity, then you can access the deal room, which will have the investment deck, track record for Gray Capital, firm overview, and we're also just going to be continuing to add due diligence materials. So depending if you want to dig really deep or just ask us the questions, giving you the opportunity to kind of slice it any way that works for you, so you can do just all the research that you need to get comfortable or decide that maybe this opportunity just isn't the good fit for you. That I totally understand. Incredibly excited for this opportunity. Again, River Club Apartments located in Evansville, Indiana. Before I jump into all of the reasons why we love this deal, why I think it's a great opportunity, and really the opportunity that should get you off the sidelines. I really think this is the deal that you've been waiting for. If you like multifamily investing, you think real estate is the most tried and true method to diversify your portfolio, preserve and grow wealth, and generate tax-sheltered cash flow, but you've been frustrated because the last 18 months, it's been an incredibly challenging environment. Interest rates have been high, prices have been even too high, and returns they haven't been good. The risk premium hasn't been sufficient to do deals. That's why Gray Capital, we haven't done a deal, or we haven't put a deal under contract in almost 18 months. While we love to be doing deals, the deals have to be right. We're all about quality over quantity, and we think that our patience has paid off and being selective in finding this great off-market opportunity. You can see just here on some highlights, we're offering a simple partnership structure, no different classes of investors, no pref equity. Really, we've had a mantra of let's keep it simple. The simple is better. Not that there aren't nuances to our strategy, and it's not all simple, but we're using just a simple 8% preferred return, 70-30 split, and the returns I think are really attractive, coming in just below 17% IRR, and that's net to investors after a 5-year hold period. Strong cash flow averaging right around 8%, and essentially looking to double your investment over a 5-year hold period. But before just getting into all the details about River Club, why we love it, just a little bit about Gray Capital if you're not familiar with Gray Capital as a firm itself. I founded Gray Capital back in 2015 with my wife, Alex. We're headquartered in Indianapolis, Indiana. And from just starting for our first real estate syndication, we currently have over $775 million of real estate assets under management. We're based in Indianapolis in the Midwest, in focus on the Midwest, kind of sticking to what we know best, where we can maximize our value and where we have clear operational advantages rather than going to other markets. But also, the Midwest is the best region to invest in right now. It's the region that has seen the most stability, still growing strong, and it's truly the story of the tortoise beating the hare, with the hare being some of the higher flying growth markets in the Sun Belt, whether that be Austin or Phoenix, or either Raleigh, markets that are definitely growing and really attractive when you look at a couple different metrics. But when you look at the net of supply and demand, those markets are absolutely getting crushed right now, where the Midwest is always stable, is always growing, grows in times of upside, but then stays stable in times of volatility. And that's ringing true again today. So that's why we love the Midwest. We love investing in what we know, which is Midwestern markets, kind of within a 4-hour range of our headquarters of Indianapolis, because we self-manage, we're boots on the ground, we're hands-on, and we have to be there presently, not just doing it over Zoom all the time. We focus on value add and core plus strategies. This opportunity is definitely in the value add category. We're typically looking at deals at the bare minimum 100 units, but we really like to see 200 units and above, with kind of 450 units starting to get to our max. This property is 444 units, so it's definitely at the larger size, but it gives us great economies of scale. Just on a little bit of our track record and why investors are reaching out to Gray Capital to commit to do this project is because we have a track record of discipline and risk mitigation in seeing around corners. Capital preservation is key. We've never lost $1 of investor capital. We've never issued an unplanned capital call ever, and we have no anticipation to do so. All of our active assets are distributing. All of them are distributing. We have not had to suspend distributions on any of our current assets. We have no loan maturities that are coming up that are going to give us any headaches. Our next rate cap maturity isn't until 2027. And all of our assets, except for one, which will soon to be sold, are all in fixed rate debt. We're vertically integrated, and we're ahead of the curve in terms of adopting technology, implementing best property management practices. We've built an incredible team of the best in property management, so we can take our assets to the next level. Because if you can't expect what you don't inspect. And if you don't have the access of your people, if your team aren't on the boots on the ground, there's always going to be a gap in communication and time to action. Lastly, we have skin in the game. Historically, the GP group, including myself, have contributed on average 14% of the equity across our projects. We're planning on investing 10 to 15%, and that equates to $2 to $3 million, well in excess of the fees generated by this deal, into the project, showing where our motivation lies is exactly where your interest is also directed, and that is the successful outcome of this project. Not fees, not just putting another trophy on the shelf, but what are the returns? How are we going to understand, mitigate risk, and drive alpha in this investment? This isn't our first rodeo. We've done many deals, including over 10 full cycle projects, many active projects, and you'll notice we've done many projects in the Evansville market itself where River Club is located. This will actually be our 4th investment into the Evansville market. And over time, our team continues to grow. Again, we've built an incredible team of multifamily experts, both out on the corporate side as well out on our great residential property management team. Like I said, this isn't our first time doing this. This is just 2 examples of other great capital assets, kind of our 2 different strategies that are seeing a lot of success. The first one, just quickly, Villas on Fur, which is a core plus asset in northern Indiana, suburban South Bend, specifically in Granger, Indiana, 290 units. It's a newer asset. We've really been able to increase operational efficiencies, drive returns. That asset has been distributing on average 15% annualized cash on cash returns, especially just this last year in 2023, where again, many sponsors have had to suspend distributions on their investments. The property below is called Club Meridian, and it's probably the closest analog to the scope and strategy that we're going to execute at River Club. Club Meridian is located up in Okemos, Michigan, which is a suburb of Lansing. It's a 406 unit property that has undergone interior unit renovation of very similar scope as we are going to do at River Club. And it's doing incredibly well, 98% occupied. It's absolutely crushing right now. All right, well, let's talk about River Club Apartments. Again, it's located in beautiful Evansville, Indiana. Evansville, which is at the southwestern kind of tip of Indiana. We're acquiring the property for $45 million. That equates to $101,000 per unit. And based on the seller's financials, that comes out to right at a 6.41% cap rate. It's an incredibly attractive cap rate, allows us to achieve some positive leverage and really get favorable returns. We really are buying right. And I'll mention this again later in this video in the presentation. The basis is so incredible on this project. You know, if you're familiar with apartment pricing, price per pound, $101,000 per unit, probably sounds very attractive to you. But if you're not, you know, what is it relative to? And you may not be familiar with the Evansville market. So just as a comparison, an asset that I sold about 2 years ago in Evansville, it's actually an older property built in 1975, where River Club was built in 81, 84, and then there's actually a 2016 portion as well. But sold a property built in 1975, smaller, not as good location in Evansville for $140,000 per unit. Again, we're buying River Club for $101,000 per unit. That represents a 30% discount from the peak of the market. Now, we don't know if we're at the trough of the market, if we've already been there, if we're almost there, but we're in the range where this pricing makes a lot of sense. It blows replacement costs out of the water. New construction is going to cost about $250,000 per unit to build a new multifamily property. We're buying it for just $100,000. And by the time we're done renovating the asset, which I'll get into the full scope of the renovation plan here shortly, we'll still be all in for around $125,000 a unit. That's all our all-in cost. It still represents a steep discount to an older, partially renovated property in a substandard location. All right. So you may not be familiar with Evansville. I understand if you're not from Indiana, if you're not from the region, probably haven't been to Evansville. That's okay. It's the third largest city in Indiana. The population is around 120,000 in the city itself, about 350,000 in the MSA. But what Evansville acts as is a regional hub to the southwest Indiana, kind of northwest Kentucky, and southeast Illinois for a region that has about 900,000 people, with Evansville acting as that regional hub. We're seeing some moderate population growth. You know, the one knock and just being transparent on Evansville is that the population growth doesn't jump out at the charts. The results of that, though, is a market with really attractive supply and demand fundamentals, because it's leading to very little new supply coming online in the market, but there is still growth. And job growth actually is really strong at 1.1%, median household income of $71,000, and strong rent growth. Even in times where we're seeing national rent growth decline, Evansville is actually still going pretty strong. Just jumping around to some data points. On the bottom in the bottom left quadrant of these graphs, you're seeing a chart of deliveries and start in the Evansville market. And you see one of the bar charts actually goes negative, and that's because about 100 units or 175 units were actually taken offline in 2023, and you really see almost no new starts or deliveries. Now, we do know, and this data is from CoStar. CoStar's data is not always completely accurate. They don't have all the information. We know of some projects that have actually been built. There have been around 300 units that have been delivered in the last year, but that's a true drop in the bucket compared to demand. You see occupancy on the top chart of the screen. The bottom line is the Evansville market average, kind of sitting right in that 94, brushing up against kind of 95% occupancy, kind of going back to 2019. Very relatively stable market, not seeing the occupancy declines that we've seen in some other markets that are witnessing strong supply coming online. The top line is River Club occupancy. You can see that it essentially bounces back and forth, really between 96 and 98% occupancy, with only one point in time that it touched kind of 93.5% for a brief period of time before increasing again. You can see recently, you see it's had some strong occupancy growth. On the bottom right is the year-over-year rent growth between 2019 and 2023 for Evansville. Similarly, we show both the property, River Club, as well as the Evansville market. In the Evansville market, we didn't see the 30% rent growth that some markets saw back in 2021. But again, it's much more moderate, has never gone negative, and bottomed out at only 2% rent growth last year, whereas other markets were bottoming out at -1 to 3% rent growth. And recently, just in the last fourth quarter, we've seen an acceleration in rent growth, reaching back to a 4% rent level. And again, that's when most markets are experiencing negative rent growth. Specifically, River Club's location in the market is about as good as you can get. Again, I mentioned the previous property that I sold, not as an ideal location. It was a little bit south of this location. We are immediately off the interstate, I-69, which connects Evansville up to Indianapolis, with Bloomington kind of on the way. Right across the interstate, you'll see to the right is Deaconess Gateway Hospital. That is the largest regional hospital in this region that serves for 900,000 people and certainly serves all of the Evansville MSA. There's another hospital just to the west, Ascension St. Vincent's. And then to the north and slightly west of the property is where all the best retail in Evansville is. All the big box stores, grocery, restaurants, medical office, and then whether it is Target, Costco, Walmart, PetSmart, Home Depot, Lowe's, Meijer Menards, you name it, it's all in this region. So that means a lot of jobs and a lot of convenience factor to residents. When they're looking at where am I going to live in Evansville, how close am I to the grocery store? How close am I to the Costco? And then how quickly can I get to work? Whether I work at the hospital across the street, or maybe I'm working at the Toyota manufacturing plant that's about 20 minutes up I-69, which we know a lot of residents at River Club actually work at. It has great wages, but the property has great interstate access, which makes it incredibly convenient. Another compelling fact about Evansville and why we're bullish, not just on the market and the property, but our strategy to renovate units and drive rents and drive returns, is that the incomes are really growing in Evansville. Evansville has been conducting a study every year, the city of Evansville, every year since 2016. Bowen National Research has conducted a third-party study on the housing and incomes in the Evansville market. Essentially, their conclusion is that over the next 3 years, by 2027, there's going to be a 30% increase in those individuals earning $50,000 a year or more, and a decline in individuals earning less than $50,000 a year. Well, $50,000 or more a year is right in the sweet spot for the potential renters that we are targeting, because about $50,000 a year, if you break that down for affordability and a monthly rent, what they can afford, weighted at 30% of their income, comes out right to around $1,200, which is more than what we're going to be charging in the first couple of years at River Club itself. So really strong job dynamics, really strong income growth, that all kind of is pointing in the right direction and gives us confidence for our plan. But looking at where River Club sits in the market today compared to other properties, we can see that even without doing anything, we've got a good $100 of spread between us and comparable properties. You can see River Club is the lightly shaded gray compared to other properties with some of the higher end Class A properties, which there are only a handful in the market, at the right hand of your screen. Again, this gives us a lot of indication that even on some of the units that we don't renovate, and we're only going to renovate about 50%, we should be able to drive organic growth, one, based on just a simple mark to market, but also we're going to be doing a lot of amenity and exterior improvements that will increase the curb appeal of the asset and be able to make it that much more attractive for a resident to pay a little bit more, which gives us confidence that we're going to be able to drive organic rent growth also, even though we're not really factoring that into our model and business plan. Here's just another look at some of the 1 and 2 bedrooms. Kind of shows a similar trend of kind of being in the back half of where rents are in the market, but it's an incredibly well-maintained property. You're going to see some more pictures, but a property that was built in 1981 and 1984, you can have some issues if it's not properly maintained. But we've already executed our physical due diligence. We've walked through every single unit of this property already. We've walked every exterior. We've documented it all. It's in shockingly good shape. Not that there isn't work to do, and there's not a couple pieces here and there to improve. There always is, especially at a property this size and of this age. But it's giving us a great platform to start on. And again, I'm jumping ahead of myself a little bit, but some of the work that the current ownership has already done has already kind of given us a head start on our business plan. So why do we like this deal? And I've already touched on a lot of this, so I'll go quick. And then I want to get into more of what we're going to do with our value add plan, the condition of the property, get into the returns, and talk about the timeline. Like I mentioned, it's a great basis, $101,000 per unit versus $140,000 peak is just very strong. Economies of scale of 444 units. We can not only be properly staffed, but we can afford the best talent in the market. I've already talked about submarket demand, the growing incomes, and the lack of housing. Well, yeah, I guess one piece that I did fail to mention, also included in that Bowen National Research Study, is based on the growth in incomes and growth in jobs. Evansville necessitates an additional 2,800 units by 2027. 2,800 new rental units in the market. We looked at that chart of supply. On that chart, there's no new units coming online. Now, I think that there'll probably be around 300 to 400 that do get delivered that CoStar's missing, but that's still a drop in the bucket compared to the 2,800 units that we're going to need. That's only going to drive demand and drive rent growth over time. Attractive returns. We're clocking with, I believe, some conservative assumptions. Mid-teens, right now looking at 17% IRR exit net to limited partners after a 5-year hold, and strong cash flow averaging around 8%, starting at 6% cash on cash distributed in the first year of operations. Again, we'll be distributing monthly. That means the month after we close and you make your investment, we will be sending you an ACH with your first distribution. We're going to be forcing appreciation. If you're not familiar with forcing appreciation, the difference between forced appreciation and natural appreciation is if we just bought the property, sat back, relaxed, and said, the market will take care of it. Let's let cap rates compress and hopefully market rents will grow. And you know what? That can work over time. But it's a slow process. And you are abstaining your control. You're setting your control down and just letting the market guide you. We want to be in control of our own destiny. We want to drive returns. We don't want to be dependent on whatever the market wants to do. We can't control the market. So by going in and renovating units, increasing rents, we end up increasing our net operating income. Commercial real estate is valued based on the net operating income divided by the prevailing cap rate in the market. That's the most common method to value real estate. There's other ways to do it, but that's the most common. There's a direct result from the rent that we charge, what the net income is, onto the value. So by pushing the net operating income, by increasing rents, and the way we can increase rents is by renovating the units, renovating the exterior, we are then able to force the value of the asset much faster than if we just let market forces do it for us. The last thing, tax advantaged. 100% bonus depreciation most likely will be back in 2024. It's working its way through the Senate. That means that we were going to be able to provide passive losses in the first year of operation. We're also getting more moderate leverage than we have been able to get in the last 2 years. We're getting over 75% loan to value. And so that will also allow for us to make some pretty strong distributions of passive losses that'll show up on your K1 that can offset future regular income through distributions to the property, or if you're a qualified real estate professional, it can offset other income as well. Obviously, it's not tax advice. Consult your own tax advisor. Last piece, and this goes to the confidence that we have in the deal, and I've mentioned this, but the GP group, we're putting in at least $2 million of our own cash, and I'm also personally guaranteeing the loan. I'm not bringing in another guarantor to do that for us, and we'll pay him a fee. That's what a lot of other groups do. I'm the one that's going to be signing personally on the Fannie Mae debt for this project and putting my own cash into the deal. Let's look at some pictures, see what this thing looks like, give you a little bit of taste. You can see there's 2 lakes at the property itself, and you saw some in the drone footage. On the top right corner is where you're going to see some of the 2016 developed townhomes. There's only 20 of these. I wish there was more, but they've got direct access garages. They're large units, 2 and 3 bedrooms, and they're all achieving $1,800 to $1,900 a month in rent, and they're almost always 100% occupied. It's a great opportunity, and there actually is room to build potentially 16 more of these types of units at the second clubhouse of the property to continue to drive revenue and have even a wider variety of rental options, floor plans that can cater to a wider range of demographics. And you're going to hear me mention that a couple more times today. Looking at some of the amenities, it's got a bunch of racquetball courts. We're looking at converting those into pickleball courts or reusing them in some way. It's got a great dog park. We're probably going to be moving that. And then a brand new outdoor pool. They've actually, they poured concrete in their old pool, have a really nice concrete deck outside of the clubhouse, and they built a new, nicer pool, new furniture last year right off the side of the main clubhouse. They've also they updated the fitness center. It looks great. They've updated the leasing center, which really allows us to focus on a lot of the more kind of revenue driving items. In addition to some of the common area improvements they've made, every roof has been replaced in the last 8 years. Every window in the property was replaced last year, and every patio sliding door has also already been replaced. And those are items that we can't charge more rent for. People expect their window to not leak and to be good quality window. We're not going to be able to charge $25 more a month just because the windows finally work. In terms of the interior units, there's really kind of 2 different styles. So the property was built in 2 phases in terms of classic units. On the top left, you see some of the classic units in the first phase. These are actually the units that we're going to be keeping. They've got actually really nice cabinets. These units and these rents are going to stay more affordable, lowercase affordable, not subsidized, but it will allow us to have, again, a nice spread of rent levels that can cater to a wider variety of incomes. That way we can cast a wider net and have maintain occupancy consistently. Now, on the bottom left, you're seeing the other style of classic interior units. Not as big a fan of these cabinets. These are the ones we're just going to wipe out and completely renovate. So we will have 50%, around 230 fully renovated, beautiful looking units. You can see the bathroom. And then on the top right quadrant, that's the kitchen of those 2016 built townhome units that look great. Granite countertops, solid cabinets, good LVT flooring. Here's just a quick video of a little bit of a walkthrough into one of the classic units. And these are one of the units that we're going to be actually renovating, not leaving classic. But you can see, I mean, they're in good shape. Even for being made in the 80s, they are in good shape. but we're still going to be renovating those. In terms of the unit mix, it's almost all 1 and 2s with a couple 3 beds in those townhomes. But fortunately, all of the floor plans are the same. There's only 2 floor plans, again, besides the townhomes. That makes it very easy to renovate, makes it very easy to lease. It's consistent. It's not confusing. It all points to really strong property fundamentals. So what are we going to be doing to these units? Let's talk about the rehab. Again, on one of the phases, we're going to be leaving essentially alone. We're going to fix what's broken. We are going to be focusing a lot and have set aside quite a few dollars to replace water heaters, furnaces. The previous owner has been on a schedule replacing those as needed. We're going to continue that schedule. We're really happy to see that they had already started that process. It was another good sign that they have been maintaining this property. They've been doing the right things. They've owned it for over 15 years. And I didn't mention this earlier. And maybe you may ask, why are they selling? Why are you getting such a good deal? And I'm detracting from talking about the rehab right now. But why are they selling is always one of the first questions and always a really good question. So they've owned this asset for over 15 years in Evansville. This is their last property they own in Evansville. And the seller over the last several years has been transitioning away from older vintage properties to newer assets. They are buying a newer property right now, kind of a core plus asset. They are setting up a 1031, which they are using the proceeds from this sale to roll into a 1031 investment. And so they needed to sell it. We sourced the project off market. We heard that it was going to be sold. People were talking about it. We had a broker reach out directly on our behalf, and we were able to negotiate it and place it under contract. We've got a great reputation in the Midwest, especially in Indiana, for doing deals, for executing, doing what we say we're going to do. The seller has a similar, very good reputation. And we got together in person out in San Diego at NMHC, hammered out kind of the final aspects of the deal, and put it under contract on February 7th. So really excited. That's a little bit of story and why they are selling. So what we're going to do. So in 50% of the units, and those are the units that I just showed you the video of, the slightly less attractive interior units, we're going to be doing what is called an occupied rapid renovation. That means we bring in a GC that specializes in this tactic of renovating an entire apartment unit, or even several, depending on how many teams you have, in a single day. What happens essentially is the team comes in, they consolidate the renters. The renter goes to work. First, start there. Renter goes to work in the morning. The team comes in just after they've gone to work. They consolidate the renter's items. Sometimes they move them out into a shipping container. There's 2 shipping containers staged outside of the building. And a large crew comes in, demos the unit, everything covered. All of the possessions of the renter are covered or put away. New kitchen countertops, new cabinets, new lighting, some paint often. Typically the kitchen floors, the bathroom floors, new bathroom vanities, pretty much everything but common area floors and some paint are all done within a single day. This allows us to renovate these 220 to 230 units in a 12-month time period rather than a 2 to 3 year time period. I mean, maybe it'll be able to get it done quicker in as soon as 9 months. That allows us to force appreciation even faster at the property and minimize the disruptions that a rehab can have on the property while you're doing the work. So we get in, add value, renovate the units rapidly. Therefore, we can increase rents sooner and be able to compound off that growth sooner rather than later. Additionally, in addition to the interior renovations, we're also going to be doing a complete cosmetic refresh of the property. You can see over on the right-hand screen of the current look of the exterior and a rendering of what the exterior may look like. We're still playing around with some of the paint schemes, but most likely going to a white or blue and white two-tone paint scheme. The idea being we want to completely relaunch this asset. When Regency Club, which is the original name of the property, when it was built back in the mid 80s, it was the place to be. It was the lifestyle apartment community in Evansville. Had the racquetball courts, the pools. It had a sauna at that point. It was big. It had all of the amenities. It was the top of the top in Evansville. And really, this style, it doesn't matter the market. The amenities of that soon to be River Club, formerly Regency Club, had made it the place to be. We want to bring that back. We want to relaunch River Club as a brand new brand and something that's really exciting, that's going to enter into the Evansville market, giving residents an opportunity and an option to have something really nice, really high-end, clean, well-maintained, but it doesn't break the bank. You don't have to spend $1,600, $1,800 to get into the Class A stuff. You can spend $1,100 to $1,200 to get a really nice unit with a ton of amenities in a great location. And by doing the exterior, that's going to further just solidify that, look, there's new ownership, there's new management. These things look great, and it's worth taking a look. So with the rebrand from Regency Club to River Club, we're going to have all new signage, a whole new look, and it's going to really come together in an awesome way. Really excited about it. So let's talk about the returns and the structure of the deal. Minimum investment is $100,000. We're looking at a 5-year hold. The partnership includes an 8% preferred return that will accrue if distributions are under that 8% preferred return. And then on normal operating cash flow, if distributions exceed 8%, there will be a split of 70% of cash flow to the limited partner, with 30% going to the GP group. In a capital event such as a refinance or a sale, first, all accrued and unpaid preferred return will be made current. Then 100% of capital will be returned to limited partners. So if you invested $100,000, first you'll get your preferred return, and then that full $100,000 will be referred to you. For any excess to be distributed after a return of capital, a split of 70-30 will occur at that point. So if another $100,000 remains after that, $70,000 goes to the limited partner, with $30,000 going to the general partner. In terms of fees, we have a 1.75% acquisition fee, a 0.75% guarantee fee, a 0.65% asset management fee, which is calculated on deployed capital, a 2.5 to 2.75% property management fee, and a 5% construction management fee. We don't have any development fees. We don't have any refinance fees, no disposition fees, no other layers of fees. These are all of our fees, which we feel are below market. Looking at returns. In terms of cash flow, cash on cash, starting the hold off in the first year with a 6% projected cash on cash return. Going further into the hold period in year 2, 7.4 projected, followed by 8.3 projected, 9 in year 4, and 10.3% in year 5. A reminder, all of these are projections. In terms of break-even occupancy, which is essentially what does our occupancy need to be for us to be at break-even, where we can only service our mortgage payment. In the first year, we can't get below 80% occupancy to be above break-even. But after that, after we increase rents and drive NOI, that break-even occupancy comes down to the 70% range and slowly decreases from there, with an average of 70% break-even occupancy. In terms of total returns, looking at a 16.8% IRR based on a 5-year hold and a 5.75% exit cap. That equates to a 2.1 equity multiple over that 5-year period. Again, what that means is over a 5-year period, investing $100,000, you will receive $210,000 of total distributions at the end of the investment. If we're looking at average annual return, which is not a metric that we typically use, but we've seen it so often we figured might as well include it. where it's a 29.4% average annual return. I feel like all that we've seen that more and more recently because IRRs don't look that good, but the AAR is higher, and so folks are showing AARs instead of IRRs, and to each their own. But maybe you're saying 5.75, that's too aggressive. Maybe you're saying it's too conservative. I don't know. No crystal ball here. We like to, get a good sense of which direction the wind is blowing, but we don't know what cap rates are going to look like in 5 years. So that's why I always look at a sensitivity matrix to look at what could be the range of outcomes. And when we look at that, we can look at cap rates expanding all the way up to 6.75%, but also if we declined and compressed down to 4.75%. Don't look at the top left of the matrix, or you'll be telling us to sell it in year 2, and it's too aggressive. And again, we just can't plan on that. But starting in really year 3, but truly year 4. When we say a 5-year hold, what we really mean is 4 to 7 years. Year 4 is when we'll start thinking about, a potential exit depending on how the property is performing. But then we also, with a 7-year term fixed rate loan from Fannie Mae, we have some term, and it could be as long as 7 years. What we're not factoring into this business plan at all, though, is refinancing sometime in year possibly 2 or year 3, either through a supplemental loan from Fannie Mae or new financing altogether, but that's going to be completely interest rate dependent. If rates come down significantly, that could really present an opportunity, but there's too much speculation to throw that into a model. We've done it, we've got it if you want to see it, but I don't really think that it's truly helpful in terms of understanding what we could do with this investment. But just keep in mind, we do have a potential to refinance before an exit. And typically that's what we would prefer to do, to de-risk the asset through an accretive refinance, return capital, lower our interest rate if the interest rate's lower, and continue to cash flow the project while everyone stays an owner in the deal. But let's say we're assuming that doesn't happen. If let's the cap rates blow out, the market gets really bad, interest rates, inflation just really cranks, and cap rates go higher. Now that you would think that would mean that rent growth is also a little bit higher than what we're expecting, but we'll kind of take that out, assuming that all we see is cap rate expansion. If cap rates get into again, the 6.75% range, and we end up selling it kind of at the outside of our hold period in year 7, and in month 84, we're looking at a 12.14% IRR. Now, that level of return doesn't get me super excited, but also it's really not a horrible return, and about the return that you're seeing on most multifamily projects, at least the ones that I've seen recently. I wouldn't say that it's the absolute worst case scenario. Nothing's guaranteed, and as any savvy investor knows, the worst case scenario is a total loss of the investment, which has never happened to Gray Capital, and no reason to think that that's going to happen here. That's just the reality. But in a real not great outcome, we're looking at a 12% IRR. Alternatively, if we all get excited to sell in year 4 at a 5.25 cap, we're looking at just under a 22% IRR, or that it comes out to basically a little bit more than a 2.14 equity multiple just after 4 years. Selling even at a lower cap rate, obviously we can get into the 30% range. I just don't think it's very helpful to speculate. You can look at this graph to see a full range of outcomes based on the hold period and the cap rate itself. All right, let's talk about the timeline, especially if you're interested in investing, and then I'll go through kind of some of the steps that you can take if you want to learn more and get signed up and make your commitment. And we went under contract on February 7th, and our capital commitment window is now open. You're watching this. We are accepting commitments. We are getting a lot of commitments very quickly. The only way to secure your final investment is by executing our subscription documents and making your contribution to the company of River Club. Our due diligence is expiring March 31st, and we are hoping to have all capital raised by mid-March. By April 2nd, we will issue our capital call for the project, and we are aiming to close on the property by April 15th of 2024. So if this timeline does work for you, that's great. Let us know and we will get started. If you're interested in River Club, in learning more and making an investment into an asset that we're incredibly excited about, hop on over to the Gray Capital portal, which you can find at graycapitalllc.com. By getting onto the portal, you can access the complete deal room to get all due diligence materials on the property, Gray Capital. More than just the deck, we're going to be we try to be as transparent as possible. Anything that we feel like we can really legally share and it's appropriate for us to share, we're going to include in that DD deal room, so you can do as much or as little as due diligence as you'd like. Just as a reminder, this opportunity is only open to accredited investors. The minimum investment is $100,000, and we're typically capping our maximum investment from an individual to $5 million. I appreciate you taking the time to learn more about River Club, this exciting investment opportunity from Gray Capital. If you've been on the sidelines over the last year or so waiting for the right deal, well, this is the deal that you've been on the sidelines waiting for. I highly recommend you jump into the deal room, learn more, schedule a call with the Gray Capital team to discuss one-on-one and make your commitment on the Gray Capital portal today. We're excited. We'd love to partner with you. Let's go and do it. All right. Thanks again. And a reminder, if we're not past February 20th, which you might watch this video after the fact and we'll have a replay, but we're doing a webinar 1 p.m. Eastern time on YouTube Live. So go over to the Gray Capital YouTube channel. You can subscribe to our YouTube channel so you'll get an alert or get in touch with us. We'll make sure you won't miss it. Thanks again for watching. All right, let's go.